If you put $10,000 into ASML on July 18th, 2016, and simply left it alone for almost a decade, you'd be staring at a final value of $189,784.90. That's not a typo. That's not a simulation. That's the real split and dividend adjusted number for this exact window, July 18th, 2016 to July 16th, 2026. It's the kind of outcome that makes headlines and sparks envy at dinner parties. But before you picture yourself booking a round-the-world trip, you need to know the other side of this story. Because the path to that number was anything but smooth. In fact, it was brutal. There were stretches where your conviction would have been tested to the breaking point, and the pain of seeing your gains evaporate, sometimes by more than half, would have been enough to shake even the most seasoned investor. By the end of this video, you'll understand exactly what it felt like to live through those ups and downs. We'll walk through the single worst 12-month stretch, when half your money disappeared in just a year, and reveal just how long you'd have waited, underwater, before seeing your investment recover. You'll see why the outcome is only half the story, and why the journey itself is what separates the numbers on a screen from the reality of investing. Let's get clear on the math. This isn't a cherry-picked fantasy or a hypothetical backtest. The calculation is dated, split, and dividend adjusted, and based on a simple premise. You invested $10,000 in ASML on July 18th, 2016, and held every share through July 16th, 2026. No trading, no timing the market, no adding or subtracting, just a pure buy and hold journey. For context, we'll compare this to the S&P 500 using SPY as the benchmark. If you'd put the same $10,000 into SPY on that start date and held, you'd have ended up with $40,724.54. Both numbers reflect total return, so every dividend and every split is included. This is apples to apples, and the difference is staggering. But the number on the screen hides something. It hides the emotional roller coaster, the moments of doubt, and the stretches where the pain of holding on felt endless. Let's talk about compounding. ASML's total return over these 9.99 years was 1,797.8%. That means your $10,000 didn't just double or triple or even go up tenfold. It multiplied almost 19 times. The S&P 500, by comparison, returned 307.2%, a strong result by any historical measure, but not even close to what ASML delivered. Every year, on average, ASML compounded at 34.2%. The S&P 500's compound annual growth rate over the same period was 15.1%. That's a huge gap, almost 20 percentage points per year, compounded. It's the kind of difference that, over time, leads to life-changing outcomes. But here's the catch. Compounding at that rate is never a straight line. The journey is filled with sharp drops, long plateaus, and moments when it feels like all your progress has vanished. And that's exactly what happened with ASML. So could you actually have held on? Here's where the story turns from numbers to real life. ASML's maximum drawdown, the biggest peak to trough loss, was a staggering minus 56.9%. Imagine this. You're riding high. Your investment has ballooned. And then over the course of just over a year, you watch more than half your gains evaporate. The peak was on September 15th, 2021. From there, the stock began to slide, and the pain didn't stop quickly. The trough hit on October 14th, 2022. That's 13 months of watching your money shrink, day after day, week after week. But the real test wasn't just the drop. It was the wait. The recovery didn't come overnight. In fact, it took until January 25th, 2024, for ASML to claw its way back to its previous high. That's 862 days from peak to recovery, over 2 years and 4 months. For that entire stretch, your investment was underwater. Every time you checked your account, you'd see a number lower than what you once had. The temptation to sell, to cut your losses, or lock in gains before it gets worse, would have been overwhelming. This wasn't a brief dip. It was a test of patience, discipline, and emotional resilience. Let that sink in. For 862 days, you'd have been staring at a statement that showed you were still below your peak. Every headline, every market wobble, every doubt. compounded by the fact that you'd already seen what you could have had. The temptation to sell and cut your losses would have been overwhelming. Most investors never make it through a stretch like that. But the worst was yet to come. What about the single toughest year? Here's the payoff to that open loop. The worst rolling 12-month period ended on October 14th, 2022. In that window, ASML dropped by 50.7%. Picture this: you check your account and half your investment has disappeared over the past year. Not because you made a mistake, but because the market turned against you. It's the kind of gut punch that makes people swear off stocks forever. Holding through that kind of volatility isn't just hard, it's almost unnatural. It's easy to talk about staying the course until you're the one living through a 50% loss in a single year. And yet, that's what it took to see the final outcome. So how does this compare to the benchmark? ASML's compound annual growth rate, 34.2% per year for almost a decade, dwarfed the S&P 500's 15.1%. On paper, it looks like a no-brainer, but the lived experience was worlds apart. The S&P 500 had bumps, sure, but nothing like the gut-wrenching drops ASML investors endured. The difference between the outcome and the journey is massive. Most people focus on the end number, but very few actually live through the drawdowns to see it. Now, what would need to go right for results like this to continue? Here's where we have to be careful. Past returns don't guarantee anything about the future. For a company to deliver strong returns, a lot has to line up: growth, margins, competitive position, and the broader market environment. None of that is promised. Even if the business continues to execute, the stock price can swing wildly for reasons that have nothing to do with fundamentals. The only thing you can count on is that the ride will be unpredictable. But what does the market expect now? There's one more piece to this puzzle, a bridge from what happened to what's priced in today. A current reverse discounted cash flow analysis implies the market is expecting 22.2% annual free cash flow growth over its explicit forecast period. That's a big number. It's not a prediction, but it does show what's embedded in the current price. For future returns to look anything like the past, the company would have to deliver on, or exceed, that kind of growth. The stock could disappoint, even if the business does well. So what can you take away from this journey? First, the historical numbers are what they are, spectacular, but backward-looking. There's no guarantee the next decade will look anything like the last. Second, the path matters as much as the outcome. Most investors focus on the final value, but few appreciate the emotional cost of getting there. The drawdowns, the long stretches underwater, the worst single year, these are the real tests. If you can't hold through the pain, you never see the reward. This isn't advice. It's a framework for understanding risk, reward, and what it truly means to be a long-term investor. The next decade will bring its own surprises. All you can do is decide what kind of ride you're willing to endure. Because in investing, the biggest returns often come with the biggest tests of patience and nerve.